Yeah, the purpose of this panel is to talk about two things. One is the preparation phase, how to get preparation right, whether you're raising a large later stage round, which hopefully a number of people will aspire to do, or even sweeter, exiting. What are the elements of preparation that work? And then separately, we are going to talk about, in the process of doing either a large round or an exit, what has gone really well, what are the lessons learned, what are the experiences of the panelists, and what hasn't maybe worked so well. We're going to do that for a chunk of time, and then we will take questions via the tablet, which I don't have, but when I do get it, we'll be able to take questions, right? Okay, good. So what I wanted to do is just have the panelists introduce themselves, and then we'll start the Q&A here. Yep.
Mark Hunt, former COO of Sybenetiox, just been acquired by NASDAQ.
I don't have any micro, guys, so I hope you hear me. I'm Celine, a serial fintech entrepreneur. I created 2 companies. I exited Litchi.com and MangoPay, payment API. And since 2 years, I also invest in different companies. I invested in about 15 different companies. And I'm still running Litchi and both MangoPay for the French bank who acquired us.
Hi, afternoon. I'm Colm Lyon. I'm currently the CEO and the founder of Fire.com. Fire is a provider of digital accounts to businesses, like an alternative to a regular current account in sterling and euro. And up until 2 years ago, I was the founder and the CEO of RealX Payments, which was an online gateway, a business that was processing payments for about 12,500 retailers who were selling online. And that was a business that we exited and sold back in 2015.
Good. So one of the areas that's probably least well understood and maybe ultimately most important is what companies do well and don't do well during the preparation phase. And when we talked about it before the panel, what the anchor was, let's assume preparation is 18 months before an exit. A lot of people think it's a month or two. But if that's what you think, then you're not really doing preparation. Each of you's had different experiences in preparation, and I would like to go just in turn and ask each of you to maybe highlight the 2 things in that 18 months that went really well. When I say really well is things that really made a difference at the end to the outcome.
So I think from our perspective, and I guess just to clarify, we've just closed a round which is a combination of equity, debt and mezz of 135 million with Goldman Sachs and also an Indian investment company called WGC. So for us, I think the 2 things that really kind of helped us is that we had brought on board probably about 18 months ago an internal capital markets advisor. And so, we did have external advisors, but we had somebody that was almost an extension of the management team, and I think that really worked well for us. And I think the other part, which is maybe almost kind of cultural mental preparation, is just trying to understand what type of investor do we want to ultimately work with. So bearing in mind that the management team had certain, I guess, skill set, experience. So our founding team basically came from a financial services background with kind of deep understanding of credit risk. So a lot of the kind of financing things that maybe other companies may have needed, we already had those kind of sort of well within our sights, and therefore we needed to try and understand the profile of investor that we wanted to work with to kind of give us that extra stuff. So actually just having a better understanding of what we needed, which would probably be different from what another company needed, was quite important.
Can I put you a little on the spot? What one thing maybe didn't work well in the preparation phase?
So I think that I don't know if this is the preparation phase, but I always see capital raising as kind of a continuous thing. I mean, we went from C to C at Series A right through to B and C, almost kind of back to back to back, right? Mm. And so I think the thing is that, maybe there is a lack of really awareness about how long the process is going to be, how continuous the process is going to be, and also how really you almost need to have one person within the founding team that's going to be completely on point. And so it takes a while to kind of shake out what you're going to, how you're going to, manage that process, because it's pretty much an ongoing process.
So should everybody consider as their default that when they're getting to larger later rounds, they're permanently fundraising? Is that their default?
I'm hoping not.
Well, that's what you're saying.
Yeah, I think so. So I think is that, from our perspective, we have three founders. Ez is our CTO, and, he looks after technology. I'm very much kind of building the business, and Martin, who is our CEO, is really taking care of the investor side. So we didn't always have that dedicated split. It was a little bit more grey in terms of, myself and Martin would be spending a lot of time fundraising in the early days, and I think as we moved into probably 6-9 months, we kind of created a much more clear separation. So I would jump in when we were kind of at the point of having serious conversations, but we had to have one person on point in order to be able to, really have the focus that we needed in terms of trying to getting our rounds done.
Mark, if I ask you the same questions?
Yeah, things we did well, definitely taking on the right advisors at a very early stage.
And what was right?
What was right? We did due diligence on them and made sure that they really did fit the business and understood the business we were trying to grow. And I think one of the other things we did really well was actually run with their advice and accept that we didn't have all the answers. So once again, very similar. We founded, closed our first investment round. We're looking to raise again within 6-7 months, so it's just a constant journey. And on that journey, we had a bidding war start. So what was trying to raise another investment round became an actual acquisition.
Was that a surprise, or did you
very much so. We were we kept saying no.
So would you think that you're permanently selling as well as permanently fundraising?
That's the other thing we did really well. It's part of the vision you have to, and whether that's to your clients or the investors, you are permanently selling about where you're going to end up again.
So, you on the spot, what really didn't go well?
People's understanding of how long it takes.
Why was that a negative?
We had casualties, people who didn't see the picture, thought it was taking too long, and actually we lost some great people on the journey.
And what could you have done differently?
Great question. I think we could have made, it's a piece of advice I would give, if gut feeling is actually expertise that you don't realise you have, and if you think you've made a wrong decision, go with your gut and act sooner. Something we should have done.
Can you explain exactly? That sounds a little vague, but...
Clients and individuals. If you think you've made the wrong hire, if you think you've taken on a client who's going to... Actually, you're probably right. So that there's something we did badly. We could have made those decisions sooner.
Sounds like a backstory there, but we can do that. We can cover many of them. Same question to you.
Yeah, I may have a different experience. So back 2.5 years ago, we first worked for 6 months on the IPO process. We finally abandoned for a quite easy reason to understand. We are a French-based company. Aiming to be global, being listed on the French market wasn't very easy to get global. So we decided,
why?
Because the vision for French market, Paris, is sometimes not the best one, I would say. So we thought it wouldn't be a great corporate marketing being listed in Paris. So we stopped the process. It was a hard decision because at that time there was a large amount of money for IPO in Paris. Not a lot of great company wanting to be listed, but we decided to stop. We worked on 3 months for 3 months on a large run, raising 25 million euro. I was about to sign the term sheets when we finally, by almost accident, had the offer for the exit. And we worked for 6 weeks on the exit and did it.
But, I mean, forgive me, but the exits, especially high-value ones, don't just happen by accident. I mean, however you might say it, it just doesn't work like that. So
well, it is the way it is. But I'll explain why. So the truth is we really had the offer 15th of July, and we signed and closed the exit 18th of September, so 8 weeks. And I don't know if there's anyone who knows well the French market, but believe me, August doesn't even exist. So in fact, we work for 4 to 6 weeks on the acquisition, and the rest we're just hoping this will go. But then I will answer to your second question in answering your very first question.
Okay.
What works well? The fact that, in fact, we were prepared since almost the very beginning. When we raised the Series B, I asked for 2 independent board members to join me at the board. One of them was the CEO of the company who acquired us. So in fact, for almost 4 years and a half, he has knew the company by its own heart. I mean, working with the CEO of the company is the best way to understand what is the company and what is your vision and how good you are to execute and how bad you are also sometimes.
When you brought that company on board, did you have the idea that they might be a buyer? I mean, honestly?
Yes and no. It was maybe in my dreams.
Okay.
But at that time, we were a very small company. We were, I think, 10 in the company. I was 28. I mean,
Okay.
we raised 1 million. It was just the very beginning.
Okay, so you didn't
so yes and no. I mean, it was in my dream, but I wouldn't have expected.
So what's the one thing that went really badly that you... let me ask it differently, that you think you could have prevented or changed?
Well, because it went very quickly. In fact, we knew it will have to be done very quickly. We decided not to go with an advisor. So the tough part was that we hired an advisor to do the 25 million rounds. We had 3 term sheets, and we told the advisor, well, it was a good work, dear, but no work on the process of the exit. We want to do it by ourselves because we have this amazing relationship with the CEO and also with the whole company. So I even dropped name. It's Crédit Mutuel Arca. It's a very French bank. They are one of our very first bank partners. So we decided not to take an advisor because we believed that having the direct relationship was the only and the best way to do it in terms of price, conditions. But then I had 6 awful weeks, I have to say, because of course, when a bank acquires 86% of your shares, they want to know exactly who you are, even if the CEO trusts you.
Sure.
All the rest of the guys want to double check.
Colm, let's go to you and maybe we talk just about the preparation phase again, the 18 months and the two best things you did.
The 15 years.
Well, that's the other way.
Yeah. So we were an online gateway. So the company was privately held, so I owned the business. We had unsuccessfully tried to raise funds over the years, both at the start and as we were scaling, and that didn't work out. So we had a family and friends round that was done in 2001 where we raised €300,000, and that was the only amount of money that we ever actually brought into the company. And then we grew organically, I guess, over the intervening 15 years. And so we, as an online business, as a business, if you like, that was processing payments for online retailers, we wouldn't have been very vocal. We wouldn't have been building a big brand, but we would have been kind of just concentrating very hard on providing a good service. We would have aligned ourselves quite closely to the acquiring banks that operate in that space. Mm-hmm. So, and we would have built up a big base of customers. So we had about 12,500 retailers who were using the platform, and there's 28 billion a year processing through that system for those retailers. So it became a really important, if you like, piece of the ecosystem, and we'd built up this really good technology. And I think what happened to us was that we were growing at a very fast rate, 2009, 10, 11, 12, where we could see the business kind of almost doubling like in the space of about 2 years. And it was the discussion that we were having as a management team was how do we continue that growth? Because our main sales office was over here in the UK, where we had most of our market was based here in the UK. And we were trying to work out how would we continue the growth. And it was very clear to us that to continue to scale at the level, we had done great with our own resources to bring it to this point and to scale to that point. But every part of the journey, if you like, is a different story. And this new story for us was an acceptance in the first instance that the status quo wouldn't work. So we knew we had to do something from a capital perspective. We had to either raise money or we had to become part of a larger organisation. And it was one of those two things that really was the right option, but to stay exactly as we were wasn't a good option. And I think that was the the catalyst that set off the discussion for us, and we went through that journey. I think what was very fortunate for us, and the thing that always comes back to me, is that we were very strategically strong in that we had absolute clarity about what we did and what we didn't do. We knew exactly what the service was and where it was and why it was selling. We knew why businesses were buying it from us, and we had a great organisational structure and some very strong, if you like, alignment amongst the members of the management team. If they didn't agree with me, they were fired, basically. So it was very clear that this was the way that the business was going to be run. And I think it was an extremely well-oiled machine in terms of, like, for me, I had to always think about, you know, every possibility it could occur here, and therefore we have to be managed on that basis and make sure that we were ready for it. So we went into it, again, I'll leave the other bits for later, the discussion, but in the preparation stage, it was running the business just really, really, really well. It was like just absolutely being crystal clear about everything that was going on in the business, and making sure that we didn't take the foot off the pedal in terms of the scaling that we were doing at the time, bracing yourself for the advent that this might never happen, and that you might actually have to continue on your own for an extended period of time, even though we all recognised that we had to do one or the other, raise funds or become part of a larger organisation.
I asked for two things that went really well in the preparation phase. One of them was rigor in the business, so everybody understands what's going. Everybody can say the exact same thing about the business.
Yeah.
What's the other that you'd say?
I
18 months, particularly before.
We had found distribution to our customers, so we would have had like large online retailers, Virgin Atlantic, the AA Insurance, Paddy Power, Aer Lingus, some big global brands that were processing literally billions of transactions through us. And then in the later years, we found distribution through resellers. So in other words, we found the Santander in Spain, Elevon Merchant Services, and HSBC in the UK were also white labelling and selling the service that we had as well. And I think that worked to our advantage in a significant way, because we were now seeing these large financial institutions selling our service to their customers branded as their own product. And so, in hindsight, if I was looking back, I'd say that gave the company a lot of credibility, and it gave the company a lot of maturity, and it meant that the obvious buyers, if you like, to us, if we did go down the trade sale route, would probably be an acquirer, and therefore we're already dealing with three of these people, on an intimate basis.
And what really didn't go well that you could have controlled in the preparation phase?
To me, it's all about the team, and it's about, like, I was going to use a crude expression, but what the expression is, if you're facing into the wind, but like you can't swim against the tide. That's what I was trying to say. and like if the tide is coming this way and you're trying to swim ahead, so for me as the CEO, probably some more upfront conversations. A lot of the decisions that we made late in the process, the key decisions, which we maybe could have made earlier in the process, and we might have had an easier process. Like, would you go trade sale, or would you go an acquisition? Sorry, would you go with selling the business right now, or do you want to raise money? Okay, and that was something that we left until we saw the options on both sides. And you would have actually decided that up front? Well, that's what I'm saying, that in hindsight, perhaps a conversation, because when I did have what we called our reflection dinner, where we had, like, we brought it down to 4 offers, 2 which were trade sale and 2 which were to invest in the firm, and I asked everybody on the management team, which side of the table do you want to go to? And every one of them said, sell it. And it probably would have been that had I said it like 9 months before that, in which case I was wasting a lot of time considering doing the opposite. Right, okay. Yeah. So just to open it up, we're going to talk about preparation for a few more minutes and we'll shift to the process, but there's an argument on preparation that actually preparation doesn't really matter, just build the best company you can. And people will find you, especially this day and age. The counter argument is there's so much noise. If you're not consciously trying to cut through and be the person top of the list, you may never get acquired, or acquired for the wrong reason by the wrong buyer. Your view? Which would you vote for if you had to vote?
Do you mean in terms of actually just getting the message out to the market about what you're doing?
Just in terms of getting the best outcome. One theory one is don't spend the 30, 40, 50% of your time on all of the stuff about dealing with buyers and things like that and warming people up, and just build the best company. Or spend a lot of time cutting through, selling proactively to people who might buy you at the end of the day. And actually, some of it might be also overlapping with what you might do commercially. Some inevitably won't.
I can answer the question because it's happened to us. We just focused on building the best company we could build.
So you did option 1? Yeah,
and actually that worked in our favour in the end, because during the due diligence process, the acquirers, because there was a number of them, they worked that out. And that was reassuring to them. That it wasn't, vaporware, or we were.
Right.
There's some vision. Actually, these people have built a company that they're really proud of, and that's the journey they're on. And it all came out in the paperwork, where we spent our money, how we hired people. So we just focused on that.
So if you, I'm not going to ask necessarily everybody to take a contrarian point of view, but if you were going to guide a CEO to do the second option, proactively do something that would lead to a better outcome on an exit or a very large round, which are different. Let's say with an exit for a moment. What's the guidance you'd give to the CEO other than build the very best company you can?
So I think the thing that I would say is that, right through seed and Series A, B, and C, we kissed a lot of frogs. Like we did a ton of investor meetings. But I think what we did was we did actually keep up to date with our investors or potential investors on a regular basis. And I'm not saying that we spend our whole time calling them, but just simple things like we created an investor newsletter, and it actually goes out to our corporate clients that actually drive our business, but it also goes out to our investors. And the thing is that allowed us to keep them up to date. So I think that when you speak to investors or potential buyers, they're always thinking, okay, this investment might not be right for me right now, but actually I want to keep tabs on this management team, and do they actually deliver? Do they do what they say they're going to do? And actually, if you're keeping tabs on them, and I meet people, socially, and even at my kids' school that I've actually met for investor rounds, and they're like, oh, I saw your newsletter, great job, and great round. And so the thing is that I don't have to do the outreach, but actually that communication is there, so that actually that then means that when we are ready to do more, they're actually almost proactively coming back into us. And so I think if there was one piece of advice is that, obviously focus on the business, but if there's a smart way for you to kind of keep on communicating to that pool of investors, then I would definitely do that.
I think Victor was going to say that the thing that you have to recognize in this process is that what you're selling and what the person is buying from you aren't necessarily the same thing. And in terms of developing relationships with people over the years who potentially could, either invest in your business or do business with you or potentially buy your business at some stage, I always thought to myself as I was seeing this process that you were selling what you had, but and it's quite tangible, and it's a business, and these are the numbers associated with that business. But what the buyer wants is hope for something more, and he's buying into a vision, and it's a vision that you're not necessarily part of because you don't know his organization. So you don't know exactly what way this is going to pan out and how the asset that you're just about to sell is going to be utilized in the context of his organization. So it's really important to try and think about, when you're selling, not to think about what you're selling from your perspective, but think about what the person's buying from their perspective, because that can completely change who you're talking to and how you approach them.
What about IPO preparation? There's a school of thought that IPO preparation is a great preparation for an exit. Others are, a lot of it's wasted.
Yeah, I mean, I have a tiny experience in this preparation, but I guess, yes. But at some point, if you start raising money, you have to know all the rules of the game, and at some point you have to go on an exit. So you have to be prepared since day one, and in fact you structure your company this way. And to complete what you just said, I believe, especially in our industry, in the fintech industry, where we are filling a gap, banks are really afraid of what is tomorrow. So the marketing we do also about ourselves and about the company is really important.
Interesting. Just because we have to cover a lot of ground, let's move to the process itself. So one of the things I know when we exchanged emails before was hire an advisor. Should you, shouldn't you? And you've run literally the entire gamut. Rather than saying, I think we should, I think we shouldn't, one positive, one negative, based on your experience? How would you help CEOs think about that, making that decision?
Okay, so I think it depends who you've got in your team and who you already have on board. For us, we were incredibly lucky. We had a chap called Abdul Goufor who works for Intel Capital as an advisor and an investor. So he's worked on hundreds of deals. So we sat down and we were very lucky. We didn't have to go and get an advisor. We had one in-house. I think if we hadn't, we could have hit some issues going forward. So the actual process has taken seven months, and he's been absolutely invaluable. I think if we hadn't have had him, we'd have been in trouble.
Would you have hired somebody if you didn't have him?
Yes. in hindsight, definitely.
Yeah, I have the same experience, in fact, and I never realized it. My general manager used to work for an advisor, and so, I mean, he had the skills too, and it helped a lot. And I think it also depends if you are on a process and you decide to just sell your company, and you need an advisor, because once you said you want to sell, maybe your price has decreased maybe for 20 or 30%. So you need someone to, challenge the market and challenge the offer. If you have an offer and you want to, it depends also on the relationship you have with the company who offer you the acquisition and the exit. So it also depends on the case you are working on and what process do you decide. But of course, if you know how it works, or at least someone on your team know how it works, then it's easier to go.
Let me start the other way around with you, Colm, and work backwards on in the execution phase itself. Maybe instead of things you did well, let's change it a little bit, and lessons. One lesson learned that really you think is meaningful for the audience. One takeaway from the execution process, which encapsulates maybe something you would have done differently, or something that we were surprised at. But if you could distill one, you were allowed two.
This has been recorded, right? So I can't. This has been recorded.
This is House of Rules, and nobody will attribute this to you ever. But
no, I think. I wouldn't have been through a process like this before, right? So, realistically, I don't know if a lot of people do get to do something like this, but certainly for me, I had not had this experience of selling a company, and it was an American buyer that was involved in the equation, and I think, I absolutely wanted an advisor, because to me that made complete sense for the position in which I found myself at that time. And therefore we had EY out of London here who acted on our behalf, and I found that great consolation. I found it very when things got tricky, and particularly around the number itself. There is that vulgar conversation about the number, and when do you stop, and when do you say yes, enough is enough, and when do you proceed and you actually hold out for a little bit more and all that. And that's not something that I would ever have done, and not or that I would recommend that I should have been doing, because I couldn't. And therefore that wasn't a game of poker in which I should be playing, and therefore I had to have an advisor to do that. And you need to recognize that that is the case, because you think you're going to be able to do it, but actually you're not. You do not have that experience. So do not put yourself out into that position on the field, because you're not equipped to do it. And the other person that I think was instrumental for us in closing the deal was the lawyer. That we were very fortunate to have a lawyer that was extremely competent. We knew that the buyer was coming from the US, so we presented a whatever it's called, a transaction agreement that was written in the style of a US deal, albeit under Irish law. But it was written in such a manner that it appeared like a normal, and the company that bought us are, they're doing acquisitions all the time. They kept telling us that this was a small deal, and would it be okay if they used their in-house lawyers? And I said, fine with me, yeah, I don't mind. But the next deal that they did was an acquisition for 4.3 billion. So I then realized, this was a small deal, and you realize that you are actually very, very small, and that this is something that you just need to get over the line. So concentrate on what, again, going back to understanding your buyer, and understanding your buyer really, really well. He was American, given an American trial contract, let him negotiate to the point, and then stop the negotiation, feed him all the information that they want, and get this deal done quickly, because they want to go on to the next one, because you're actually hindering the next big acquisition that they want to do. So get it over the line as quickly as you can.
One of the observations certainly people have said to me over the years is you notice over-optimization. People trying to optimize everything, partly because they can't make a decision, but partly because it's just, they think there's always a little more.
Yeah. I remember it was Patrick's Day, and Patrick's Day for us is a holiday, and we were all kind of moaning about the fact that we had to come into the office, to work on Paddy's Day. And so we all arrived in, and the guys were there, the buyers were there, and we went through the morning, and then halfway through the meeting, isn't there a parade on today? Do you mind if we just call it quits now and we just want to go down and watch the parade? And I kind of think, we wanted to do that too, but we didn't. So again, it's that kind of thing about just being prepared to get things over the line. When we were terrified when they were bringing over their own legal counsel that this guy was going to just rip up our contract to shreds. That's the first thought in my head was, his guy's going to take out a big red pen, he's coming on the plane on the morning of St. Patrick's Day, and he's going to take everything out and just rip it all off. All the things like the minimus claims and whatever they are, I forget them all now, but all these kind of critical things in the contract. And he just went, it's fine. We're going, it's okay, yeah, they're all fine, we don't need to negotiate them. All right, we do this all the time, it's okay, it's fine. And like, what you think sometimes is going to be a problem, as you say, doesn't be a problem at all.
Lesson learned.
There's something I would like to raise. First, I agree with you regarding the lawyer. The one we took, we were the third company that he was selling to Crédit Mutuel Arca. So the first reaction of the M&A team at Crédit Mutuel Arca was, oh, not again him. That was like, maybe it's a cool choice. And lesson learned, you have to manage your own shareholders, and it can be a pain in the neck, to be polite. In my experience, the BA we're doing between 10x and 12x on the acquisition. VCs between 5.5 and 6x. That I believe is a pretty good deal, right? But still, for a lot of reasons, they can decide it's not yet the right timing to sell, or maybe they could even do more money, or maybe, a lot of maybe. So it's really very important for me that someone in the team also deal with the shareholders, the marketing with them. In my experience, they weren't, as I said, very happy to sell because the timing was short, so I had to pretend I didn't want it to work a lot more. And at that time I was 32, so it was easy to say, oh, I'm a solo founder, I'm a woman, I'm 32, so maybe it's the right timing for me to focus on another topic, etc. So dealing with the shareholders is also sometimes a little bit tough.
That's a very good point.
I concur, which I shouldn't say.
Well, that's fine. You can, but I want your own independent lesson learned.
Remain open-minded. So we had offers earlier and decided as a team it was our baby. We didn't want to be acquired. In hindsight, I think with the amount of work it took in the end and the timing, we could have got to that decision slightly earlier. So that's a lesson learned for the whole team, me included.
I would say a couple of things. So the deals get done in the boardroom, and that's all the spirit of the deal, and the kind of like do we like the number, etc. But whether the deal kind of like lives or dies is really done in the data room, and very much around your operational competency. And so I would just say even when you're kind of doing your very early rounds, it's really important to make sure that your data room is a reflection of your business and you don't cut corners, because it does actually then kind of have an impact on the number of people that are actually interested in your company, and it has an impact in terms of the valuation that you ultimately get. And so the level of scrutiny and sort of due diligence you have to go through is intense. Obviously I don't have the experience in terms of the sale, but even in kind of some of the late rounds. And so I think the thing is that my main point would be just don't cut corners.
So I'm going to shift to one or two questions that here, and then if anybody else has a question there. But one question that was raised was about buying or selling a regulated business, particularly a business regulated in a different market. And what could you, should you, or did you do well, badly, that, your takeaways from the regulated side of things?
Well, I just remember some things that we needed the central bank to give the okay for doing the process. 4 weeks, August, really nightmare. So, but it was really tough for us because we really wanted to go fast. We didn't want it at all. The press knew that we were about to sell the company, etc. So we had to put a lot of pressure on the regulatory. That is something that is also not very easy to do, generally speaking. And more seriously, I believe everything has to be in order. Otherwise, the single tiny dust will make the deal fail. So just everything has to be perfect. There is no other choice.
Other observations on the regulated side of things?
We had Relax was not regulated, but we had regulated activities, so we kept them in a separate firm, which was Fire, which I bought out. So keeping the regulated activities and the non-regulated activities separate was very much to our advantage, because at the time of the transaction, the buyer wasn't interested in the regulated activities. So, I bought basically 100% of Fire just before we sold Relax, which meant that we didn't have to go through a lot of work at the time to separate it out, those two things. we didn't have to do a big kind of project to, to separate the thing out. We actually had them as separate companies. And one was owned by, Fire was 100% owned by Relax, and that gave us the flexibility to be able to sell the non-regulated activities of the firm without actually looking at the regulated activities, and I remained the owner of the regulated entity, which was very helpful to have the company organised in that way at the time of the exit.
We literally have time for one or two other questions from the floor. So I've covered, if anybody's got any particular questions or not observations, but questions would happy. Okay, well, I guess somebody does. All right, well, I'm going to keep it open then. I have a couple of maybe final observations from distilled from what you were talking about. A couple of things that are surprising that came out. One was this whole idea of an internal advisor that some of you talked about, which is not normally well understood. And people normally think about having an advisor as hiring somebody externally. I can tell you, having worked in the advisory business, that the satisfaction rate's about 50%. So it's not that great with external advisors generally. So actually having somebody you trust internally can be a very good way of doing it. The other thing that struck me and maybe struck some of you is this concept of permanent selling, permanent fundraising, for better, for worse. How you organize yourself. Guidance a lot of times we give to CEOs is you should spend, during the preparation phase, 20-25% of your time dealing with or navigating buyers if you're going to sell the company, and almost nobody ever does. But the concept of permanently doing it being part of the job description. And in your case, in several cases, allocating someone. So you actually specifically had a resource internally to do it, which I don't know how many companies at the late stage actually allocate that responsibility to somebody, and that becomes a reasonable part of their job.
I think it's very difficult, Victor, to sell a company just because you want to sell it.
It's impossible.
It doesn't work like that, you know. Right. And it goes back to what I was saying earlier, that, our buyer has since taken the gateway that we gave him, that we sold to him, and loaded up billions more business onto it. Right, it's solved a huge problem for them, and it's enabled them to go to market in new regions with a piece of technology that they didn't have. So the need has been satisfied, and that was the reason for the sale. The sale didn't happen because I wanted to sell. The sale happened because they wanted to buy, and that was the bottom line.
Yeah, and it sounds like in your case it was a product of an awful lot of work.
Yeah, lots of hard
Just
work.
Just awful lot of work.
Yeah.
I mean, that's the other takeaway, is sheer graft.
Yeah, we were very lucky. So the thing is that we've got some really motivated people. There were some really late nights, early mornings into the kind of close of the deal. It was 6 months of relentless DD. And so, I think that, as you said, we had an internal capital markets advisor who was almost running the deal team internally, and it was kind of dedicated focus, and that's all they did, and they lived and breathed the deal. And so, there was just no easy way around it.
All right. Thank you all. Really appreciate it. Thank you for your time. Good.